What's up everyone, it's Caddy with MoneyVest. So thank you so much for joining for yet another video. We've had a lot of members join our community and our YouTube channel over the last month. So I wanted to welcome everyone and wanted to once again reiterate and go over the concept of valuation. And this one metric, right, in isolation could tell you a little bit more about the company's valuation and whether it is actually a good opportunity or a bad opportunity. You see, in the markets, there are four types of companies. There's companies that are good, there's companies that are bad, there's companies that are undervalued, and there's companies that are overvalued. Okay? Our job is to find the dislocation in the market. And by dislocation, I mean that the four companies that I just mentioned, there's going to be a combination of just one of those possible outcomes, which I'll go over in just a minute so it clears things up a little bit better so that we are focusing our energy, our time in high quality companies, good companies that actually do offer up that opportunity, and there is a dislocation in the markets. So I hope you guys enjoyed this video. It's going to be a little bit of educational / psychology of investing kind of involved in one video. So I hope you guys enjoy it. Make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the buy and sell alerts, options alerts, trade ideas. Everything is going to be included, as well as the members only private videos. We do have a 16% annual discount that does expire at the end of this month. So there's a few more days left if you want to take advantage of that as well. Link's going to be down below. So I'm going to be using an example of one of the most popular memes of Drake, one of my favorite rappers. And this right here is the meme that we're going to go over. So the four companies that I mentioned, great companies, bad companies, overvalued companies, undervalued companies. So we're going to draw some conclusions from that market analysis. So what do we want to avoid? We want to avoid great companies with bad valuations, right? In other words, bad valuation meaning overvalued. We also want to avoid great valuation companies, right? Companies that might be undervalued, but they are bad companies, right? The management is not great or the future potential is not that great, whatever the case might be, but they are just in general, or our expectations are not that great with that company's intangibles. Or we're looking at a bad company with a bad valuation, which obviously, without a doubt, we want to avoid at all cost. Oftentimes, you'll notice that a lot of investors do get sucked into this sort of criteria, the number one, which is, just a phenomenal, great company, but of course, trading at a very, very expensive valuation, very overvalued level, and that's where draws a lot of capital. We see a lot of IPOs that go on board and go online in the markets where there's great companies, but they're very, very expensive, but a lot of investors do get sucked into these IPOs or do get sucked at the very top. And next thing you know, you have overpaid for an asset, right? So, I mean, case in point, Elon Musk paying, over $50 billion for Twitter, right? Great company, but definitely overpaying at a bad valuation. Well, what is that going to do to you? That's going to lower your future returns. You see, your returns are directly correlated with the price you pay. I'm going to repeat that. Your returns, your future returns are directly correlated with what price you pay for that asset. Okay, regardless of, and when I say regardless, I'm not literally saying regardless, but in a rhetorical way. Regardless of the quality of the asset, your price paid is what's going to determine your future returns majority of the time. You buy a house, you buy gold, you buy Bitcoin, you buy stocks, you buy a phone, you buy a watch, you buy a car, whatever it is, whatever you buy, whether you make money on it or you lose money on it in the next 10 years is going to determine how much you pay today. That's what's going to matter, because if you already pay too much, there's not a lot of profit potential left in that investment. If you already overpay, there's not a lot of margin of profit left in that investment. So our job as investors is to constantly be on the lookout for great companies trading at great valuations. That's where the dislocation happens in the market, yeah, right? Because oftentimes what you will see is the first one, right? Great companies trading at bad valuations. And by bad valuations, I know there's a negative connotation to it, but by bad valuation, I mean expensive valuation, right? Trading at significantly higher than the market expectations. In other words, their 5-year averages or the S&P 500 or their sector median. So that's what I really mean. By bad, I don't necessarily mean that it's terrible, but I just mean that they're trading at expensive valuation. A lot of investors obviously do get sucked into sort of that criteria because The reason why they're trading at an expensive valuation in the first place is because the price has moved up so much. And so when the price goes up, there's a recency bias, right? There's human brain kind of starts thinking about that stock, about that company, that, oh, it's a great stock, it's a great company, it's just going to keep going higher, so might as well just invest in it, right? And that's what happens in that first scenario, is that it's a great company, and the reason why it's trading at an expensive valuation in the first place is because it's a great company. And of course, that recency bias triggers more buying, which creates more increase in the stock price, which creates even more expensive valuation, and then that cycle repeats itself until the last investor who wanted to buy has already bought, and that greater fool's theory comes to an end, and of course the stock price collapses. So our goal, like I said, in the market is to look for great companies trading at great valuations. And one of the metrics that I'm going to go over, again, you can't just necessarily look at that one metric in isolation, but it's a good measure of understanding whether that company is trading at an expensive or a relatively inexpensive valuation relative to its own growth. Okay, and that is going to be the PEG ratio. Now, we've talked about this in our previous videos. I've kind of mentioned this PEG ratio multiple times in our stock analysis videos, but I want to take a little bit step further and go over some of the pros and cons of using a PEG ratio, and why it can be important when you're screening stocks, why it can be important to use this ratio, but also you want to dig deep and understand exactly what that growth rate looks like, because what we're dealing with here is the actual price to earnings ratio. So price to earnings ratio, you already know, which is basically the stock price divided by the earnings per share. You can look at the trailing or the forward. The forward is based on expectations. So forward PE divided by, again, the growth rate of the actual earnings, right? So that's going to be the growth rate. And then you get to a PEG ratio, which is going to be the PEG ratio, price to earnings divided by the growth rate. And that number is going to be somewhere around, I would say, like between 0 and as high as 4, 5, or 6. I mean, these numbers can obviously go as high as they like, but usually, I mean, the general band of most companies, they're going to be trading between 0 and 4, right? PEG ratio. And the closer it is to 1, the better aligned, it is with respect to its growth rate, right? If the P ratio is almost identical to the growth rate of the earnings, then those companies are considered to be fairly valued. If it's trading at under 1, right? So if it's trading between 0 and 1, then those companies are considered to be kind of trading below their PEG ratio, basically inexpensive relative to their growth, right? So in other words, the price the stock price is trading at is inexpensive, or trading at a discount relative to its growth. Of course, if there's any company trading at over 1, then you definitely want to take a look at that company and, kind of do more research and understand, what's really the reason as to why it's trading at an expensive valuation, why it's trading at a bit of a premium. Now, before we jump into some of the companies that I'm going to show you in the big tech sector and what their PEG ratios basically look like, I want to go over some pros and cons, because again, like I said, you can't just look at this number in isolation and kind of judge a stock whether it's expensive or cheap. You have to do more research, because it definitely has its drawbacks as well, which I'll go over in just a minute. But the pros, okay, first of all, the reason why this metric, I like to use this, is because it filters out unprofitable companies right off the bat, right? Because if a company is not profitable, I'm not that interested in that company to begin with, because, profitability is very, very important. It's key to understanding the business's long-term success and the fact that it can be sustainable, it can be viable. Now, there are companies that I might be interested in that are just turning the corner towards profitability. So last couple of quarters have been profitable. Maybe they're not profitable on a yearly basis, but the last couple of quarters have been good. So for example, Palantir, for example, Airbnb, there's a lot of companies that are actually turning profitable now that will start generating a price to earnings multiple. But PEG ratio and PE ratio basically filters out unprofitable companies right off the bat, right? So if the company's not profitable, it's not going to have a PEG ratio, because it's not going to have a PE, because it's not going to have any earnings. Second pro is that it considers the company's growth, right? The price to earnings is basically taking into account the valuation itself, but the PEG ratio takes into account the company's growth as well, right? So it takes into account how much the growth is going to be for that company, and relative to that growth, where's the valuation? And it also levels the playing field, right? Because the PE multiples are very subjective to industry, are very subjective to the stock that you're analyzing, are very subjective to the sector that they belong to. But the PEG ratio basically levels the playing field, because it's basically a valuation relative to the company's own growth, and it puts them all on the same page, right? So if a company is growing faster versus companies growing slower, their PE ratio will reflect that, and their PEG ratio should level the playing field with respect to that growth, right? So those are some of the pros. Now, but there are a lot of drawbacks and there are a lot of cons. So I want you guys to use this metric, right, to understand whether companies are trading at expensive or inexpensive valuations, but don't take it solely at its face value. Do more research because it does have drawbacks. Like, it doesn't tell you the full story. Growth is an estimate, right? The earnings growth, the forecasted growth is an estimate at the end of the day, and that estimate could be wrong. So if you are looking at a company that's trading at, let's say, 0.8 PEG ratio, you might think to yourself, oh, wow, it's inexpensive. It's cheap right now. It might be a good buying opportunity for that stock because it's dislocated. I like the company. It's a great company and it's trading at a lower price. Caddy said, below 1 PEG ratio is cheap. Well, growth estimates could be wrong. I mean, the company's earnings might not actually play out what analysts are expecting it to be. And as a result, if earnings do decline, PE ratio goes up and that PEG goes from 0.8 to maybe 1.2 or 1.4 or 1.5, right? So growth is an estimate in this scenario, and it could be wrong because, again, it's based on analyst expectations. It's based on your expectations. And finally, it may not be appropriate for value or dividend companies because they generally grow at a much slower pace, and the dividend is not included. The value aspect, the share buybacks, all those things. Indirectly, it is included to some extent because share buybacks is going to increase the earnings per share, which is going to lower the PE, which is going to lower the PEG ratio. So indirectly, yes, there is some component to it. But of course, the companies that do pay out dividends, that is not included in the PEG ratio. So you may be kind of looking at, a company that is very, very cheap on a PEG ratio basis, but the growth really isn't there anymore because it's a dividend company, right? So there are some drawbacks. And for those reasons, we obviously have to do more research, but this is a good starting point just as a quick screening process where you can look at the PEG ratio and quickly kind of understand, okay, do I want to spend time researching on this company or do I want to move on and look for different companies? And I'll talk about some of the psychological aspects of this process later in the video, so bear with me here, but let's just quickly go over some examples, right? Apple, for example, trading on a non-GAAP, right? Non-GAAP. I look at non-GAAP, especially for big tech. If I'm looking for super speculative companies, I would definitely look for GAAP numbers because non-GAAP, there's a lot of adjustments. But for Apple and a lot of these big tech companies, it doesn't really make much difference. So I'm looking at forward, so next 12 months non-GAAP PEG ratio, which is going to be at around 2.76. So very, very expensive, right? So in other words, what does that actually mean, right? What does 2.76 basically means? That basically means that Apple right now is trading at a valuation which is 28, 29 times earnings, which is more expensive relative to Apple's own growth for its earnings, right? So 2.76 is certainly a high number, in my opinion, which is one of the reasons why I'm not really buying Apple at these prices, even at 170s or 172. And I'm waiting for better prices, right? I'm waiting for better deals. And that's the thing, right? If Apple comes down to that level, great, I will be a buyer. If not, there's plenty of other fish in the sea, right? There's plenty of other stocks to look at. And that's what we're going to get into. Like later in the video, if you stay with me till the end of this video, I'm going to go over some psychological golden nuggets, which I think are going to be timeless and very, very important for your investing career. So stick with me here. But 2.76, definitely very expensive for Apple, in my opinion, for PEG ratio, 29 times earnings multiple relative to its own growth, trades at an expensive multiple. Now, if you take a look at Amazon, Amazon's much better, right? I mean, PEG ratio, non-GAAP forward, 1.58, still not ideal, but better, right? Better than Apple, still not ideal, still not preferred, which is one of the reasons why I have Amazon's fair value at under $100 per share, right? That's one of the reasons because I expect Amazon to become more profitable. In fact, we did an analysis on big tech. If you go back and watch my videos, I did an analysis on Amazon, and what did we learn? We learned the next 10 years, Amazon's growth in EPS is more than Nvidia and that it's more than Tesla. So that is something incredible, right? I mean, it's going to be growing at a faster rate. 18%, if I remember correctly, was the growth rate for Amazon over the next 10 years, which is better than Tesla and better than Nvidia. So that's why I'm more excited to be dollar cost averaging into Amazon than I am on Apple or Microsoft, for example. But of course, it's not ideal. I would prefer to buy it at 1 PEG ratio, which, I think if it does drop down to $96, $97, that's really where my fair value is. That's when the PEG ratio for Amazon will be closer to 1. Next one on the list, NVIDIA. Now, this is controversial, okay? I'm going to be honest. This is controversial. NVIDIA is right now, as it stands, trading at a better PEG ratio on a non-GAAP basis compared to Apple, Amazon, and probably the lowest right now, compared to a lot of other companies. However, once again, I want to point you to one of the drawbacks that we have. It doesn't tell you the whole story, and growth is an estimate. Right now, I know that there's a lot of investors that are very optimistic and excited about NVIDIA's growth and earnings per share expectations. Again, the EPS growth expectations can change. And they are, in my opinion, are a little bit more inflated because of what we have witnessed with artificial intelligence. The AI boom in 2023 has gotten a lot of investors very excited, and it's kind of hard to foresee what the next 10 years are going to look like, which is why I think EPS expectations are very inflated for a lot of these companies, right? It pretty much, they're based off of the expectations that AI is going to be this huge industry, and which it will be. I have no doubt in that. But there's going to be more competition. There's going to be an equilibrium for returns on capital. And I do believe that there is going to be market share that's going to be divvied up. Not just NVIDIA is going to have 80% as it has right now, but it's going to have other competitors as well, because it's a very big market and there's a lot of opportunities. And I doubt that companies like Amazon, Apple, Google, Meta, Microsoft, AMD, Intel, they're all going to back down from the fight with artificial intelligence. Of course, they're not in the chip designing business, but you don't know what the next 10 years look like, right? So I do think that yes, 1.14, you can make a case that NVIDIA is fairly valued right now. You can buy NVIDIA at $400 and you'll be happy over the next 10 years. I have no doubt in believing that. But something tells me that, again, 20 times sales, 30 times enterprise value to sales, trailing 12 months, it's still very expensive, right? So that's why you can't just look at it on an isolation, just the PEG ratio. You have to look at other valuation multiples. You got to understand the whole story. And like I said, I think the EPS expectations, in my opinion, are a little bit more inflated. Now, I'm going to trigger some people in the comments, but that's totally fine. That's my opinion. Tesla, no doubt, very, very high. PEG ratio is going to be sitting at a little bit over 3. So very, very expensive. That's one of the reasons why I've sold covered calls and I'm not buying Tesla at the moment. The moment it drops below $200, closer to 170s, 150s is where my fair values are. And I'll be looking at selling puts. So we are obviously expecting a pretty sizable decline in Tesla. Now going over to Meta. And this is on the opposite side of the coin because, again, Meta expectations have also increased because of artificial intelligence. If you were to look at this, 6 months ago, 8 months ago, this number was at over 3, right? Because the growth expectations were in a huge decline. Meta was kind of like seen as this company that's completely dead. Who even uses Facebook? That was the narrative. So I'm just trying to explain to you how quickly these expectations change. And that's one of the drawbacks of PEG ratios, is that based off of growth expectations, right, for EPS, and that can change very, very quickly. So Meta under 1, again, you can make the case that it's undervalued right now or even fairly valued. And I would totally be on board with that, but it's just based on the growth expectations. Google, 1.35, so very similar to Amazon. I do like Google, at these prices. And of course, the lower it gets, the better the valuation becomes. And I will be looking to buy more and dollar cost average more. AMD, 1.14. So that's one of the reasons why I'm actually more excited about buying advanced micro devices the lower it gets. And it's been selling off. It finally broke down below $100 is because its PEG ratio is now sitting at 1.14. And the lower it gets, the better the deal becomes. And of course, AMD is going to be at the top of the watch list for me to dollar cost average and sell some puts in this stock. Finally, Microsoft 2.26, so very similar to Apple. Microsoft does trade at an expensive valuation relative to its own growth expectations. So for those reasons, Microsoft is not on my watch list right now as a buy target or anything else. Like, I'm not interested in dollar cost averaging in Microsoft at the moment. But of course, if it does sell off, it pulls back down to better levels, I'll definitely let everybody know in the Discord when and where I'm buying Microsoft. And finally, these are some things that I want you guys to remember. So investing is a discipline of relative selection, right? What is relative selection? It's basically meaning that you have to weigh your opportunities in the market, right? Because you have to be very, very selective because your capital is limited, right? So look, nobody has unlimited capital in the world. Like, you don't have unlimited capital. I don't have unlimited capital. We only have X amount of capital available to us. So our job is to be selective, and our job is to say no more than we say yes, right? Because there's over 17,000 stocks in the world, and our job, like I said, is to be as selective as possible. Because with respect to investing in individual stocks, it takes a lot of discipline, it takes a lot of patience, but at the same time, it takes a lot of understanding and self-awareness of valuations and not getting sucked into the recency bias of stock prices. Prices will go up and down all day, for 8 hours a day. They will go up and down. They will go crazy all week, all month, all year. Our job is obviously to, as a long-term investor, I'm telling you, our job is to look at the company and where is that dislocation? Where's the value of that company and whether that company is good enough to be investing in and whether the price obviously is trading below or above that value. That's our job. And if you can find it, great. If not, then move on. The market's big enough for us to find plenty of stocks out there. So say no more than you say yes, and be selective with your criterias and your standards for investing in individual stocks. So hope you guys enjoyed this video and found it helpful. If you did, make sure that you drop a like. A little bit of a longer one, but definitely wanted to get some things across with respect to valuation, because we've had a lot of people join over the last month. So I wanted to, again, establish a foundation of what we really focus on the channel here is high quality companies trading at good valuations. So you'll never basically see me talk about unprofitable penny stocks or, altcoins or, speculative companies. Like, that's not going to be us. We're going to be focusing on high quality companies, profitable companies with good cash flows, good balance sheets, great valuations, and again, investing defensively and in a disciplined manner with a good process. So hope you guys enjoyed this video, found it helpful. Make sure that you drop a like, subscribe to the channel. Link to our Discord, Patreon is going to be down below. Happy investing. I'll see you all in the next video.